I've decoded the hidden signal pointing to a massive economic shift in 2026, and it completely redefines what's coming for global markets. Right now, a foundational economic rhythm that investors have trusted for years seems to have broken. The predictable 4-year pulse that guided everything from business cycles to digital asset prices has gone silent, leaving everyone asking one question: what changed? The answer isn't found in market charts, but in a quiet, bureaucratic decision made in the halls of power. In early 2022, with interest rates still anchored at zero, the U.S. Treasury made a critical adjustment. It extended the average maturity of its debt. By moving refinancing deadlines from 4 years to 5, they didn't just adjust a spreadsheet, they added an entire year to the global macro clock. This single, technical shift is the reason liquidity has been weaker than expected. It's why the explosive, high-growth phase of the market cycle, what some analysts call the banana zone, has felt delayed. I only pieced this puzzle together recently when I recalculated the entire model. They changed the fundamental structure of liquidity itself. To understand why this matters, you need to see the bigger picture. My framework, which I call the system decoder, starts with a simple formula: economic growth comes from population growth, productivity gains, and debt growth. For decades, the first two drivers have been fading in the Western world as populations age. So, what's left to fuel the engine? Debt. And not just any debt, government debt that's now used not for new growth, but to service the massive existing pile. This creates an inescapable loop. An aging society earns and produces less, so tax revenue stagnates. But governments don't cut spending, they borrow more. And when the debt burden becomes too large, the only way to service it is to create new money, liquidity. This is the silent, non-negotiable engine now driving our financial system. The most critical chart in macroeconomics shows this inverse lockstep. As the working-age population declines, government debt skyrockets. It's not a political story of overspending, it's a mathematical story of demographics. Japan is further down this path. Europe is on it. The United States is following. The game, quite simply, is using new liquidity to pay old debts, like using one credit card to pay off another. So, what does this have to do with the price of digital assets? Everything. Crypto isn't magic internet money disconnected from reality. It's a high-intensity expression of this global liquidity system. When liquidity expands, capital flows into the riskiest, most non-traditional assets first. Bitcoin's famous cycles weren't random. They were syncing perfectly with the 4-year debt refinancing and liquidity cycle that started in 2008. Now, with that cycle stretched to 5 years, the timing has shifted. The great refinancing wave, over $10 trillion in the US alone, is now scheduled for 2026, not 2025. The liquidity required just to cover interest payments between now and then is measured in trillions. This isn't speculation, it's arithmetic. The pressure in the system is building, not releasing. The new money isn't fuel for growth, it's a life support system for a debt-based world. This changes how we view the current market. The sideways grind, the impatience for a major rally, the feeling that the altcoin season has been stolen, it all makes sense. We are not in a recessionary economy. We are in a liquidity pause economy. Main Street hasn't experienced a true expansionary cycle yet. Key indicators like the ISM Manufacturing Index haven't even crossed into true growth territory. The business cycle lies ahead of us, and probabilistic models suggest it could accelerate rapidly in the next 6 to 9 months. This is what drives risk appetite. When earnings rise and confidence returns, capital moves further out on the risk curve, into small-cap stocks, high-yield bonds, and yes, into alternative digital assets. Your beloved alt season isn't dead, its clock has been reset. So, let's talk about 2026. With the debt rollover wall hitting and a likely surge of fiscal stimulus for political reasons, we are setting up for a powerful liquidity impulse. This doesn't mean old patterns are gone forever. We face three possible futures. Scenario 1, the elongated cycle. This 5-year rhythm becomes the new normal. Liquidity waves build slower, last longer, and require more patience, but the peaks could be higher. Scenario 2, the one-time anomaly. After this post-pandemic reset, the market snaps back to the classic 4-year beat. Or, Scenario 3, the maturing market. As crypto integrates with the traditional system through ETFs and institutions, volatility dampens. Rallies become more staggered and sustainable, driven by compounding rather than mania. In every scenario, one truth remains: digital assets continue to absorb global liquidity faster than any other class. The structural forces, distrust of debasement, search for digital sovereignty, are stronger than ever. Understanding this macro framework doesn't just tell you where we are, it helps you see what comes next and build the patience to wait for it. In a world paying debt with debt, scarce digital assets aren't just an investment, they're a new form of logic. If this deep dive into the hidden mechanics of our economy gave you a clearer picture, your support is vital. Please hit the like button, it signals to YouTube that this analysis matters. And to make sure you navigate the shift ahead with clarity, you must subscribe to Winds of Thought.